How's it going, everyone, and welcome back to Exploring Investments with Justin. In today's video, what I really wanted to cover was some of the key terms or phrases that you might hear as a new investor and you might not know what they are. And so what I want to do is go over some of those common phrases and just tell you a little bit more about what I look for when I'm looking into a company's financials. And for the purpose of this video, we'll be looking at Facebook's financials as well as Xcel Energy's. And I really chose these two companies because Facebook has an amazing balance sheet, whereas Xcel Energy doesn't really have that great of a balance sheet. And I really want you to see, especially as a beginner, what the difference between a good balance sheet and a bad balance sheet is. So with that being said, let's jump right into Facebook's income statement. So looking at Facebook's income statement, the key things that I look at whenever I'm reading this financial statement is their total revenue, as well as how much of their revenue is going towards research and development, and their net income. So for the purpose of this video, let's assume that I own a car dealership. So you can think of revenue as the total amount that the company sells. So whenever I sell a car, the cost of that car that the buyer is paying, that's my revenue. So if I sell you a car for, let's just say $30,000, I made $30,000 in revenue. Now, when we look at net income, this is going to be your total revenue minus your expenses and then minus any taxes you pay as a company. So for example, say I sell you a car for $30,000. That car cost me $20,000 to get from the manufacturer. And then on top of that, I have to pay another $5,000 in income tax. That would leave me over with $5,000 in net income. That's the $30,000 minus the $20,000 that I paid to get the car, minus another $5,000 that I paid in taxes. So whenever you hear someone say that a company made X amount in net income, that's essentially how much they made in profits. And if we look at Facebook's income statement, we'll see that they made just about $73 billion in total revenue and had net income of almost $21 billion. Now, if we look at the research development under operating expenses, we'll see that they almost spent $15 billion on research and development. And like I said before, I really do like to look at how much a company is spending on their research development, because this gives me a really good idea of how much they're reinvesting back into the company to try and innovate or create new products. So that's pretty much the gist of the income statement. It really just tells you how much a company is making in revenue and how much they're making in profits. Now, when we look at the balance sheet, this really gives you insight as to how healthy a company is from a financial standpoint. And like I said before, we'll be looking at Facebook's balance sheet as well as Xcel Energy's. So first we'll start with what a good balance sheet looks like. So we'll be looking at Facebook's here. So the balance sheet can really be broken down into two main parts, and that's your assets and your liabilities. Now, when I'm looking at the assets, I really like to look at what they have in cash and short-term investments, because this is money that's readily available and can be spent whenever they need it. So we'll see here that Facebook has almost $55 billion in cash. Now, I won't get into every category under the balance sheet, but one thing I do want to point out is if you look at a company's total assets, you can see that they have $133 billion in total assets. However, $45 billion of that comes from property, plant, and equipment. And if you look at other companies such as Carnival Cruise Line or Wynn Resorts, you'll see that they might not have a lot of cash on hand, but they have a lot in total assets. And this is because that property, plant, and equipment section is essentially the value of maybe the land that the building's on, including the actual value of the building and any equipment that's inside the building. So don't be fooled into thinking that just because a company has a lot under their property, plant, and equipment that they can pay for any of their debts, because these are items that can't be transferred into cash as quickly as your cash and short-term investments. And that's why those are categorized under non-current assets and you have cash under current assets. Now, when we look at the liabilities section for Facebook, you'll see that they have current liabilities and non-current liabilities. The difference between these two is essentially that current liabilities are debts that are due within the next year, and anything that's non-current is due after 1 year. So that's the easiest way to remember what that difference between current and non-current is. And when I look at the liability section for a company, I like to really look at the current debt, because that's how much debt they have to repay within the next 12 months. So we'll see for Facebook, they've got just about $275 million in current debt, which isn't really a lot given how much they have in cash and cash equivalents. And one of the things I really look for in a company is to make sure that they have more cash than they do current debt. And the reason for this is because you don't want to invest in a company that's got a lot more debt than they do cash. And when that debt becomes due, they don't have enough on-hand cash to pay it. And that's where a lot of companies get in trouble, especially given the times we're going through right now. So now we'll take a look at Xcel Energy's balance sheet. And what we'll see here is that they've only got $250 million in cash with a current debt of almost $1.3 billion. So like I said, this is not a good balance sheet because they have significantly less cash than they do current debt. Now, one of the metrics you can look at that'll tell you how much cash they have versus current debt is the current ratio. Now, this won't be a true indication of cash versus current debt because it does take into account current assets versus current liabilities as a whole. But essentially, your current ratio is the current assets divided by the current debt. So if you have a current ratio of 2, you have twice as much assets as you do debt. So for example, this might be if you have $10 in current assets and $5 in current debt, your current ratio is 2. Now, if we compare Facebook and Xcel Energy's cash versus short-term debt, we'll see that Facebook has $55 billion in cash with $277 million in short-term debt. So they have almost 200 times more cash than they do short-term debt. So they could easily pay this debt off whenever they really wanted to. But if we look at Xcel Energy, they've got $250 million in cash, but they have $1.3 billion in short-term debt. So if we looked at cash and short-term debt as a current ratio, they would have a 0.2. So what the current ratio comes down to is you want to look for companies that have at least a 1.0 or higher, because this indicates that they have more cash than they do short-term debt. Now, if it's below 1, that's a bad sign because that means they have more debt than they do cash. And this is why the balance sheet is so important to look at because, like I mentioned, it does tell you a little bit more about the financial health of a company. So whenever you're doing your research on stocks, this is definitely something you want to look at in addition to the income statement. So now that we've gone through the income statement and the balance sheet, I want to talk a little bit more about how to value a company. Now, one of the first metrics you can look at to value a company is their earnings per share or EPS. And this tells you how much money a company is earning per dollar for each share that's outstanding. Now, you can think of shares outstanding as the total number of shares owned by either institutions or investors such as myself. And you get the earnings per share by taking the net income of a company minus the dividends that they pay out to shareholders and divide that by the number of total shares outstanding. So that gives you their earnings per share. And EPS really tells you how profitable a company is. So the higher the EPS, the more profitable they are. And the tricky part about this is that companies can influence their EPS by doing things such as share buybacks, because essentially what they're doing is they're taking more shares out of the market, so lowering their shares outstanding while keeping the same net income, which in turn does raise their EPS to make it look like they're more profitable than they may actually be. Now, the next metric that we can look at, and this is probably the most widely used metric when it comes to valuing a company, is the PE ratio, which is essentially the price to earnings ratio. And you can get this number by taking the share price divided by the EPS. And the PE ratio is essentially how much money investors are willing to pay for each dollar of earnings. So a high PE ratio could indicate that a company is overvalued because investors are paying too much for each dollar of earnings. However, at the same time, a high PE ratio could also indicate that investors are expecting high growth moving forward for a company. And that's why you'll see companies like Amazon or Tesla with pretty high PE ratios, but these are companies that are expected to grow significantly in the future. And when you're looking at a company's PE ratio, you don't want to just look at what their PE ratio is. You want to see what the industry average is to see how they compare to the competitors. So for example, let's just say that Bank A has a PE of 15. So that means that investors are paying $15 for each dollar of earnings. Now you might think that's average and that's normal, but what if I told you Bank B had a PE of 5? So now you might look at Bank A and say, okay, their PE is 3 times higher than Bank B's. So I think this company might just be overvalued. But it also works the other way, because you might be looking at Bank B and see that they have a PE of 5 and the other company has a PE of 15, and you might think, okay, this company is definitely undervalued. So the PE ratio is definitely a metric that most investors will use when determining how to value a company. Now, before I end the video, I do want to cover the definitions for some common terms you might hear. So if you hear somebody talk about ticker symbol TSLA, that's the ticker symbol for the company Tesla. And basically, ticker symbols are just how companies are identified on stock exchanges. But you do want to be careful, especially as a new investor, that when you're looking up companies, you're looking at the right ticker symbol. So what we'll see here is that Ford, the car maker, has a ticker symbol of F. But if you were to look up ticker symbol Ford, F-O-R-D, you'll find the company Ford Industries. And we've already seen this in the past couple of weeks, where a lot of new investors thought that they were investing in Zoom, the video conferencing company, which has a ticker symbol of ZM, but they were really investing in the company Zoom Telephonics, which has the ticker symbol ZOOM. So as a new investor, I can't stress this enough. Make sure when you're doing your research, you're looking at the right ticker symbol for the right company. Now, another common term you'll probably hear is either year over year or quarter over quarter. And essentially what this means is if we're looking at Q1 of 2020 and we say that, they grew revenues 20% year over year, that means that from quarter one of 2019 to quarter one of 2020, they grew revenues that much amount. Now, one of the terms you might see or hear that's very similar to year over year is the trailing 12 months, or it might be abbreviated as TTM. And you might see this under PE ratios or EPS, and they might talk about the trailing 12 months of a company. And essentially what this is, it's just the last 12 months. So you might also hear forward PE or trailing PE. And essentially what this means is if you're looking at a forward PE, that's based off the estimates for the earnings of a company moving forward, whereas the trailing PE might look at the past 12 months or even further out. And the last term I want to cover is compounded annual growth rate, or CAGR. And essentially the compounded annual growth rate describes the rate at which an investment would have grown if it had grown the same rate every year and the profits were reinvested at the end of each year the same. So for example, let's say a company grew 100% over 5 years. You would take that 100% divided by the 5, and that would give you a compounded annual growth rate of 20%. So essentially, the compounded annual growth rate is giving you an average return rate over a certain period of time. So as always, make sure to leave some feedback in the comments section. And if there's any key phrases or terms that you need further explanations on, be sure to let me know and I can explain those for you. So if you feel like you got some value from this video, make sure to let me know in the comments section and give this video a thumbs up, as it really helps support the new channel. And if you would like to stay up to date with all of my new uploads, be sure to subscribe and hit the notification bell. And for everybody that's watching the videos on the new channel, I do want to say thank you and I appreciate your support. So with that being said, thank you guys, and I'll catch you on the next one.